Welcome to the Dev Journal. We are witnessing a fundamental pivot in the world of artificial intelligence. The industry is moving past the era of chasing raw compute power at any cost. Instead, we are seeing a massive push toward structural consistency and standardizing how these systems actually talk to one another. Today, we examine how the Model Context Protocol aims to fix the mess of disconnected data sources. We will also dive into the latest move from Google to give developers granular control over how long their models actually spend thinking before they provide an answer. It is a quest for efficiency over pure scale.
Sloan, those engineering tweaks are fine, but the real pressure is visible in the supply chain. We are tracking the staggering $500 billion hardware backlog for NVIDIA heading into their major conference. Meanwhile, MongoDB is facing a brutal week as executive turnover clashes with a potential technical bounce for the stock.
Financial stakes now match the underlying technical complexity. From the release of a new secure environment from Alibaba for autonomous agents to the high stakes of quarterly earnings, we have a lot to unpack. We begin with the attempt to create a universal language for model integration. This is the Dev Journal. This new Model Context Protocol represents a rare moment of unity between major competitors like Google, Open Artificial Intelligence, and Microsoft. By donating the project to the Linux Foundation, these giants are attempting to solve the N times M integration problem, where every new application requires a custom bridge. Establishing standardized primitives for prompts and resources means that retrieval augmented generation pipelines will finally have a predictable foundation. Instead of writing unique middleware for every database, developers can rely on a shared specification that allows different systems to communicate with file structures and web tools effortlessly. The potential for human interaction is even more striking with the introduction of Model Context Protocol apps. Imagine an agent that does not just talk about travel, but actually renders a full React component for flight seat selection directly in your chat interface, turning a simple conversation into a functional application.
While the user interface layer sounds convenient, the underlying transport mechanics tell a much more complicated story about performance. Moving away from local standard input and output to remote services using modified Open Authorization 2 specifications is a massive architectural shift that requires significant overhead to maintain decentralized relationships. Looking toward the 2026 roadmap, the priority on horizontal scaling for transport protocols highlights just how much strain these hyperscalers expect. Microsoft and Google cannot rely on simple connections when managing thousands of agents, and this level of complexity is where the promise of a universal standard often breaks. We also have to address the massive security surface area created by delivering interactive hypertext markup language and React components through this protocol. This looks dangerously similar to the Node package manager ecosystem, where supply chain risks are rampant and requires rigorous hash verification to ensure we are not executing malicious code. Practical implementations with GitHub and linear servers allow agents to manage pull requests directly within source control, which sounds efficient until you consider the trust required. Granting an automated system the power to modify code repositories through a shared protocol demands a level of security that the industry is still struggling to define. This necessity for trust and isolation brings us to the broader question of where these automated processes actually live. We need to pivot from the connectivity protocol to the secure, self-hosted environments where these agents actually execute their code, beginning with a new release from the engineering teams at Alibaba.
Alibaba just released OpenSandbox under the Apache 2.0 license, providing a standardized and open-source execution layer for autonomous artificial intelligence agents. It serves as a powerful self-hosted alternative to managed sandbox services that usually impose per-minute usage fees or restrict the execution of arbitrary scripts. The ability to move from local development directly to production-scale Kubernetes deployments without changing a single line of code is a massive win for enterprise teams. It removes the friction that usually slows down the deployment of sophisticated agent workflows across large-scale cloud infrastructure, while maintaining a consistent environment. This tool arrives with native compatibility for major frameworks, including LangGraph and Google Application Development Kit, making it incredibly accessible for developers already working in those ecosystems. It even supports Claude Code and the Gemini command line interface, ensuring that diverse engineering teams can integrate it into their existing stack immediately. What really stands out is the support for graphical user interface agents via virtual network computing, allowing these systems to interact with visual elements. By providing a secure environment where agents can actually see and click, Alibaba is pushing the boundaries of what autonomous systems can accomplish in real-world software.
Hearing you describe the interface makes me wonder about the plumbing, specifically how that Go-based execution daemon manages stateful Jupyter kernels. This architecture provides the granular control necessary for high-performance code execution and complex reinforcement learning training, which requires a very stable underlying environment for consistent results. The technical choice to use server-sent events for real-time output streaming is a smart way to handle low-latency feedback. When an agent is managing a file system or executing code, developers need to see those changes as they happen without the overhead of traditional polling or heavy protocols. They have organized this into 4 specialized environments, ranging from coding agents to reinforcement learning training modules. By separating these concerns, the fast application programming interface server can manage container lifecycles effectively, ensuring that the heavy lifting of reinforcement learning does not compromise the responsiveness of the coding tools. While we have solved the problem of where these agents execute their logic, the intelligence driving them requires a different perspective. We should move from the execution infrastructure to the models themselves, focusing on how Google is optimizing the cost to reasoning ratio with their latest release of Gemini.
Google is pushing the envelope of speed with the release of Gemini 3.1 Flash-Lite, achieving a 2.5 times faster time to first token compared to its predecessor. This isn't just a minor iteration, because it introduces 4 distinct programmable thinking levels that give developers manual control over reasoning depth versus speed. By allowing engineers to dial reasoning up or down based on specific latency requirements, Google is addressing the rigid nature of previous model deployments. This flexibility is paired with a massive drop in input costs to just 25 cents per 1 million tokens, which changes the math for high-scale operations. These price points finally make sophisticated tasks like high-scale synthetic data generation and knowledge distillation economically viable for mid-sized firms that were previously priced out. It opens a door for organizations to build proprietary datasets using top-tier logic without exhausting their entire annual cloud computing budget in a single month. Beyond the pure economics, the model maintains a competitive 86.9% score on the GPQ, a diamond benchmark for expert-level logic. I wonder if the hardware requirements for such high-performance logic at these speeds are starting to put pressure on the underlying architecture. Vance.
That 86.9% score is certainly a high bar, but I have questions about how that expert-level logic holds up under the new 45% increase in overall output speed. We often see a trade-off where rapid-fire token generation leads to subtle hallucinations that can break complex workflows. The integration of DeepThink Mini logic from the 2026 roadmap is intended to maintain consistency during these faster bursts, but environment modeling is notoriously difficult to stabilize. When an agent is simulating a system, even a tiny logical drift can compound into a complete failure of the simulated environment. We also need to consider the 128,000 context window and how it handles multimodal inputs like video alongside this high-speed reasoning. Processing that much data while maintaining logical consistency requires incredible coordination between the software layers and the massive processing power of the data centers themselves. While software efficiency like this helps maximize every cycle, the sheer volume of these high-scale deployments is driving an unprecedented demand for the silicon that makes it all possible. We should look at how the massive financial scale of that hardware is currently being reflected in the latest outlook for NVIDIA. Looking at the supply chain reveals a massive backlog of $500 billion for the upcoming Blackwell and Rubin architectures. This staggering figure is supported by nearly $700 billion in projected capital expenditures from the hyperscalers. It shows that the hunger for heavy compute hardware is not slowing down at all right now. The company reported 65.47% year-over-year revenue growth, which is paired with an exceptional 71.07% gross margin. These are numbers we usually associate with high-margin software businesses, not companies that manufacture physically complex silicon at this massive and growing global scale. Their forecast for the first quarter of 2027 sits at $78 billion, easily beating the analyst estimates of $72.6 billion. Even with a high stock beta of 2.38, the fact that institutional investors hold almost 70% of the float provides a very solid foundation. It seems like they have built a financial fortress that is almost impossible for competitors to breach in the near term. But I wonder if you see any cracks in that narrative when we start looking at how they are managing their massive cash piles and capital allocation. Sloan.
When you see a return on equity of 101.48%, it signals that the management is maximizing their resources with incredible efficiency. On top of that, the board authorized a $58.5 billion share buyback, which reinforces the idea that they have absolute pricing power in the market. They are sitting on $96.68 billion in free cash flow, giving them the flexibility to invest in the next generation of platforms like Vera Rubin. Analysts are setting a price target of $264.25, which suggests a lot of room to run from the current price. The upcoming conference in mid-March is going to be a major catalyst as they detail the Blackwell Ultra product ramp-up. It is not just about the hardware itself, but the way they are positioning the entire platform as the essential foundation for the future of global computing and enterprise infrastructure across every single industry. While the hardware side looks like a certain bet for now, we have to contrast this level of certainty with the execution risks and volatility hitting the software and data layer. Specifically, when we look at the recent earnings plunge and executive turnover at companies like MongoDB. The recent market reaction to MongoDB has been nothing short of a shock, with shares plummeting 24% in a single session. This massive sell-off followed weak guidance for the upcoming first quarter profits between $1.15 and $1.19, which fell short of analyst expectations. Beyond the immediate financial numbers, the sudden departure of both the president of field operations and the chief revenue officer has created a massive leadership vacuum. Losing two top executives simultaneously introduces a significant layer of execution risk that complicates the narrative of their otherwise impressive 29% growth journey. It is a difficult situation because the underlying cloud business is actually performing quite well, with MongoDB Atlas revenue growing by 29% year-over-year. However, that growth is being overshadowed by a net loss of $129.07 million this quarter. Investors are clearly worried that the high costs of scaling are eating into the long-term stability of the platform, despite a strong revenue beat of $695.1 million. I am curious if the technical indicators suggest any hope for a recovery from this level. Vance.
Sloan, if we look at the raw data, the relative strength index has hit a deeply oversold level of 22.66. While the price sits at $252.73, This extreme reading often precedes a significant and necessary technical relief rally. We have to look at the divergence between their 73.32% gross margin and that negative 10.77% operating margin. The infrastructure is incredibly efficient at generating gross profit, but the high beta of 1.51 is amplifying every single piece of negative news. Even with the current volatility, some analysts are keeping a price target of $380, which represents a massive premium over the current trading price. They seem to be betting that the core database technology remains indispensable even as the company navigates this messy period of leadership turnover. The stock is certainly testing its floor near the 52-week low of $140.78 after this massive correction. It provides a sharp contrast as we pivot from the volatility of cloud data to a traditional retail sector story, finding growth through strategic acquisitions.
Transitioning from the high-stakes world of cloud data to the retail floor, Kontoor Brands just delivered a massive fourth quarter 2025 performance. Their revenue reached $1.02 billion, marking a 46% increase year-over-year. A large portion of that success came from the strategic acquisition of Helly Hansen. Managing the actual physical goods behind those massive sales figures is where the real story lives for me. Management reported a 26% reduction in inventory levels alongside this earnings release. It suggests that they are successfully streamlining their entire supply chain operations and moving product more efficiently than we have seen recently. The confidence from leadership extends well into the future, with an adjusted earnings per share guidance for 2026 set between $6.40 and $6.50. This projected increase of 15 to 16% signals that the company believes the momentum from their recent apparel acquisitions is truly sustainable. They are also getting serious about the balance sheet, with plans to make $225 million in voluntary payments to lower their leverage by late 2026. I am looking at these optimistic numbers, but I wonder if the market has already priced in too much of this good news, Vance.
To find an answer, we should look at the momentum from a strictly quantitative perspective, where red flags are appearing on the charts. The 14-day relative strength index has climbed to 72.43, which clearly places the stock in overbought territory. This suggests that the current price may be overextended. We should also examine the massive 35.12 percentage point gap between their 44.55% gross margin and the 9.43% net margin. While they are making money on the sales, the operational inefficiencies are eating a significant chunk of that profit before it ever reaches shareholders. Maintaining a debt-to-equity ratio of 1.98 is a significant weight to carry in this market environment. Carrying $791.16 million in total debt creates a heavy burden for a retail company, regardless of how popular their new brand acquisitions might be among consumers right now. Whether we are analyzing apparel inventory levels or artificial intelligence reasoning, the common thread is always operational efficiency. As we conclude, it is clear that these disciplines tie together everything from retail logistics to software development. This is our final wrap-up on how operational efficiency connects apparel inventory to artificial intelligence reasoning levels. The hardware demand for NVIDIA remains staggering with a $500 billion backlog, while the software layer moves toward the OpenSandbox secure application programming interface. As we see a market that is simultaneously desperate for raw processing chips and hungry for a unified way to execute autonomous artificial intelligence agents across secured environments.
Vance, those infrastructure pressures are precisely why we see the Model Context Protocol gaining such rapid traction as a new industry standard. Because this transition from raw power to architectural standardization means the industry is finally building the pipes to connect these massive models and turn scattered islands of data into a cohesive ecosystem. As these standards solidify and the focus shifts toward how we can reliably integrate these tools into our daily lives, we hope these insights into hardware backlogs and architectural shifts help you navigate the technical landscape. And we truly thank you for joining us today for a deep dive here at the Dev Journal.